Let's take this discussion forward. Joining us right now, Jeff Snider, Head of Global Research at Alhambra. Jeff, hi, afternoon. Thanks for joining in. Let's begin by focusing on exactly what my colleague just highlighted. The risks that this ongoing tariff hike on China stands as opposed to the impact on equities. What kind of an impact are you anticipating?
Well, equities are interesting because I think a lot of times they follow along with central banks, whatever central banks are doing. Early last year we had a global sell-off in January 2018 that I think was related to the global dollar system, and it was sort of a wake-up call that, hey, maybe this globally synchronized growth thing wasn't exactly proceeding as it was supposed to. And then for much of the rest of 2018, that was sort of set aside and forgotten about, and share prices, especially in the United States and Europe and India, of course, they rebounded from those early lows. However, well, central bankers were, dismissive initially. Obviously, by the end of the year, in India in particular, share prices recognized that there was something wrong out there. There's something wrong with the global economy, the global monetary system, and so you had this bout of volatility, this big sell-off across global markets. And I think the Indian market was one of the first to actually pick that up. We're talking about August, late August, throughout September and October, and it wasn't until October 2018 where the global market started to pick up the same sell-off. And I think a lot of that had to do with the realization that whatever that had happened early in the year hadn't gone away. There was a lot more economic uncertainty, a lot less liquidity in the dollar system globally. That sort of caught up the entire global stock market. Now, ever since then, especially since last December and January, it seems as though stock markets have rebounded pretty much everywhere. The Indian markets is as strong as any of the other ones. I think a lot of that has to do with the interpretation that, okay, central bankers were initially dismissive of all of these problems last year, but in November and December, they could no longer be so cavalier about risks that were showing up pretty much everywhere. And then there's this bout of this shift globally toward dovish monetary policies pretty much everywhere. And I think that's what we've observed since then, is that stock markets in particular have been buying on the premise that, this dovish monetary policy will eventually fix whatever was wrong last year, whereas the bond markets are far less sanguine about what the policy shift and what's actually wrong with the system. So it's an interesting dichotomy in 2019 where you see the very clear divergence between share prices and what's going on in interest rates and bond markets globally.
We're definitely seeing that, Jeff. Would you then say that bond markets are indicating an impending downturn, that we are set for a further liquidity squeeze?
Well, yeah, there's several parts to that question too, but on the whole, I don't think we're just looking at something like a growth scare here. There's something much more substantial to it than just okay, maybe a small transitory soft patch. As you hear central bankers especially talk about in Europe and the United States, nothing more than a couple months of softness, maybe related to one-off factors. That's not what the bond markets are pricing. In fact, you look at the United States markets and U.S. dollar markets, it's a lot more serious than that. And we have inverted curves. We have a lot of curves, especially Eurodollar futures, U.S. Treasury curves, that are saying, the Federal Reserve is more likely to cut rates this year than it is to do anything else. And then so you have to stop and ask, what's going on in the global economy that's going to make Jay Powell and the Federal Reserve cut rates, not just stop raising them, but actually reduce the federal funds rate. And I think that the only answer to that question is something substantial in the global economy, and that's much more than a growth scare. And it's much more than something that happened last year. The bond markets are looking forward for the rest of this year, and they're getting even more certain about rate cuts that may be coming. And so, a lot of beyond the curves, beyond Eurodollar futures or something like U.S. Treasuries, as we start to digest more and more of these rate cuts, we start to get more and more economic data that matches more than a growth scare, something more like a downturn, and a globally synchronized downturn. Then you start to get into all of the risks that may be present in stock markets and various other financial components, other parts of the credit markets rather than just U.S. Treasuries or German bonds or something like that.
Sure. Jeff, that doesn't paint a very pretty picture, and it does sound that we're in for some further volatility. What then would you suggest as an appropriate investment strategy at a time like this? A strange dichotomy with the valuations where they are and equities where they are and what the bond markets are predicting, as you just said. What would you suggest an investor do?
Well, what you do in these kinds of situations is become more defensive, depending on what your overall strategy is or what your overall mandate is. You want to take less risk because skew again toward the downside, not just in economic terms, but liquidity is a big part of all of this, the economic equation as well as the financial equation, simply because you can't ever get away from the U.S. dollar system. And so, we go back to October, November, December, or earlier than that in India, where you had what was essentially an air pocket, an illiquidity pocket that led to liquidations of assets all across the entire world. Yes, the central banks have become more dovish in 2019, but that's not going to fix that same problem because that same problem has developed for quite a long time now. In fact, we've been talking about it for more than a year and a half. So there are all sorts of risk present, not just opportunity risk, economic risk, financial risk, talk about valuations in the stock markets, especially in India, but also liquidity risk that can combine all these things and amplify them into a period like October, November, and December, where volatility becomes really extreme. And so what you want to do in those situations is, more defensive than, what you maybe had been doing before, again, depending on your mandate and what your strategy is overall.
All right. The likely fallout on the emerging markets, and wanted to discuss how this would really fall back upon markets like India in particular.
Well, a lot of emerging markets in general, you really want to be more specific rather than make a general case. But in general, I think there's a lot of risk in emerging markets, a lot of potential volatility, because whenever we have global liquidity problems in the U.S. dollar system, they tend to get taken out on the emerging markets first and hardest. That's exactly what happened last year. I mean, the emerging markets were the first really to experience the global dollar shortage, which caused all sorts of currency problems across the complex, including the Indian rupee, as well as stock market and financial market volatility. So, if we still have a global U.S. dollar problem, which I think we do, then obviously that's going to impact emerging markets. They didn't get it so bad October, November, December. The Indian markets in particular rebounded much sooner than obviously the markets in the West. But I don't think that necessarily obviates the fact that as long as there's the possibility of a renewed dollar shortage and all the signs point in that direction, emerging markets are particularly vulnerable. Now, I think the Indian market in particular might be the best of the bunch because there's a lot of good fundamentals in terms of what the Indian economy and the Indian financial system presents for people. But it doesn't matter in some of the more severe cases of a U.S. dollar shortage, where even the best of the bunch is going to experience some kind of negative volatility, maybe even liquidation and some kind of a shock along those lines.
Okay, so finally then, Jeff, and I know we've been discussing equities and bonds. What would you consider, however, the best place, safest asset class at the moment? Would you perhaps look at gold then in the current environment?
Well, gold's an interesting case because, as a volatility hedge, or actually a worst case hedge, it should be one of the asset classes you should turn to in one of these situations. But gold kind of acts as a collateral of last resort, and therefore it can be, rather than a hedge, it could amplify your downside risk in these U.S. dollar liquidity problems, these dollar shortages. And so you're kind of left with, okay, gold could possibly give you some upside, but there's a lot of volatility associated with it. Therefore, you might want to do something, the traditional buy U.S. Treasuries. You can go to cash, foreign bonds, even, negative yielding bonds can give you some upside protection. We've seen German bonds rally, even though yields have become negative again in Germany. There's rally potential there. Japanese bonds too, Japanese government bonds that are almost always negative. They offer you some high degree of protection during these kinds of global U.S. dollar shortage periods.